All right, you're welcome, everyone. Today's class is going to be on the Fibonacci retracement, right? This is very important because in the market, what we're looking for most of the time is trying to get an understanding of where the market is going next, right? So what we're doing is that we're looking at historical price patterns, historical price data, to determine where the market is about to go next, or what the market is about to do next, right? And when market makes a certain move, let's say in an impulse move, we don't jump into the market. Let's say it makes an impulse move towards the buy side. We don't jump into the market just to start buying because we have seen that price has made one leg of a bullish move, right? We expect to see a pullback, a retracement, before we enter on that in that direction of the move. That's the way the market works, right? And it works that way because of the sentiment of people, the sentiment of traders, the sentiment of participants in the market. So Fibonacci is one of those very powerful tools that is built into the charts, but it is built to work with the sentiment of traders, sentiment of participants across board. So this is one tool that mastering it is something that can really add another level of, of certainty, another level of certainty to your trading, another level of confidence, another level of confidence when it comes to taking very good entries and exits as well in the market. Right? That's why you want to understand how it works. I know some of us have heard of Fibonacci before. Some of us don't understand it. Some of us have understood it a little bit. Some of us have heard. Some of us have not heard at all. Right? The goal of this class today is to help us understand Fibonacci. Where did it originate from? How does it work and all of that? We'll go through that class. Probably in another class, we'll be going in depth into practical sessions. But today is for us to understand the Fibonacci levels and how they work. Okay. So first of all, what's Fibonacci? It's a mathematical sequence. It's a mathematical sequence. It starts with 0, then it goes all the way to 100, and it can even go beyond 100. Right? But these are just some numbers here. So you have 0, you have 1, you have 1, you have 2, you have 3, you have 5, you have 8, you have 13. How does these numbers, how are they arrived at? Each number is the sum of the previous two numbers. So you see 1 and 1 gives you 1. 1 and 0 gives you 1. 1 plus 1 gives you 2. 2 plus 1 gives you 3. 3 plus 2 gives you 5. 5 plus 3 gives you 8. 8 plus 5 gives you 13. It continues like that, right? So that's why that's how the numbers are, the numbers are arrived at. So key Fibonacci levels that you will find when you are beginning to use Fibonacci are 5 of them that are default, that comes to your MetaTrader or your trading view by default. There are about 5 of them. You have the 23.6 level, right? Just follow me on this as we progress with this. You will eventually have it all together. So you have the 23.6 percent level, you have the 8.2% level, you have the 50% level, you have the 61.8% level, you have the 78.6% level, right? Now the golden ratio is the 61.8 level. This is what we call the Q zone. This zone where the market is very, very, has a high chance of reversing. So when you use a Fibonacci and price gets around the 61.8 level, you will see that price will react to that 61.8 level most of the time. Most of the time. So it's that area that gives you another level of a strong level of confidence. When you see your price at 61.8 Fibonacci levels, your confidence is high as to what price is about to do going forward. Right? So Fibonacci levels are not magic. They are psychology-based price reaction regions. Now, one thing to understand, guys, about the market is that the market works by the sentiment of traders. The market works by the sentiment of traders. There's actually a report called the Sentiment of Traders, COT, right? That Sentiment of Traders is a report that comes in every week. Traders get to look at it every week. For traders who understand or know it, look at it every week, and they are able to see where the market is going. So the market runs on sentiment. Now, for anybody who knows how technical analysis works based on sentiment. If you and I expect price to reverse at certain levels, it is very likely to reverse at certain levels. Why? Because you think it's going to reverse at certain levels, at that level. And what do you do when you believe something is going to happen? You take a chance. You take a trade. You make a move. Remember, as you are making a move, I am also seeing the chart and I'm making a move. Another person is seeing the chart and making a move. An institutional trader is seeing the chart and making a move. Everybody is seeing the same exact chart. So if you and I have a good reason to think that price is going to reverse around certain levels, then price is likely to reverse around those levels. Why? Because we are going to make it happen. It's more like a self-fulfilling prophecy. You are acting because of what you think. I'm acting because of what I think, and then the thing becomes. So what is Fibonacci retracement in trading? So Fibonacci retracement is a technical tool, is a tool that you find on your chart. It's on TradingView or is on MetaTrader. Somebody is writing on the screen. Please stop. Okay. So it's a technical analysis tool. It's a technical analysis tool that plots horizontal lines on key Fibonacci levels, right? So it's a technical analysis tool that plots lines at key Fibonacci levels. So you see those numbers that we did the other time, 28% and 8%, all those are what we call key Fibonacci levels. Now you will see horizontal lines. This Fibonacci retracement tool plots horizontal lines on those areas. Ibama, please stop messing with the chart, with the screen. Just take your note and take notes, please. Thank you. Right. Then, so what does this do? It helps traders spot price where price might reverse on the chart or continue a trend. Now, this is what you're looking for all the time, right? Where is price likely to continue a trend? Because what market does is that market makes an impulse correction, impulse correction, impulse correction. Now, when price makes an impulse, there is no opportunity there. The price has to now make a pullback or a reversal. So it's usually areas of reversal, price reversal, where price move from a downtrend to from an uptrend to a downtrend, or where price continues from an uptrend, continuing an uptrend, or continuing a downtrend. Those are the areas in the market where there's usually opportunities to make profit. Those are areas where market is usually opportunities to make profit. So if we have a tool that can help you spot those areas to a very high level in terms of probabilities, then it's a very, very good tool for us to use. This is actually why Fibonacci works very well. In my experience, Fibonacci is one of those tools that you can actually use that's on your chart. It is highly, highly effective. So what instruments can you use the Fibonacci on? You can use it on all instruments, on Forex, on stocks, on commodities, indices, crypto. I have used it for all kinds of instruments. I use it to trade all kinds of instruments. So there is no restriction. Oh, it works for this, or it doesn't work for this. It doesn't work that way. All instruments can be are affected by these because it is human beings. Remember, the market moves the way it does because of human emotions. So whenever you have a human beings as the common denominator, you will expect to see the same behavior most of the time. You will expect to see the same behavior or about the same behavior. So when you talk about the Forex market, you talk about the stock market, you talk about commodities market, indices market, the crypto market, who are the participants? Human beings. And since human beings are the ones playing there, you expect human emotions to come to play a lot. And we've said before that the patterns we see repeating themselves in the market is usually because of human emotions. Human beings tend to take actions based on what they perceive to as what will happen next in the market. And as you are seeing it, I am seeing it as well. Right? So that all markets are affected by this. And Fibonacci tool is a tool that's very effective for whatever market you decide to trade. Right? So how do you draw Fibonacci on the chart? Remember I said we're going to get to the practical sessions, right? Now, if you're in an uptrend, note one thing first. If you're in an uptrend, you're looking mostly for buy trades. If you're in a downtrend, you're looking mostly for sell trades. So if you're in an uptrend, you use Fibonacci to get areas of market continuation. If you're in a downtrend, you are looking to use Fibonacci for market continuations as well. But then we said that when market makes an impulse, then it makes a correction. What you're looking for is that area where price begins, after correcting, it begins to move in the right direction, in the direction it was going before. So if price was in an uptrend, it makes this huge impulse move, then it starts to correct. That correction, how far will it go? How deep will it go? Fibonacci will help you find out how deep that correction will go. So you will know the approximate areas where you should be entering the market, right? So if you're in an uptrend, you are drawing your Fibonacci from a swing low to a swing high. This is very easy. We'll show it on the chart. When we get to the chart, we'll show the chart. Now, you're in an uptrend, you are taking Fibonacci from a swing low to a swing high. And then when you you identify your swing low, you identify your swing high, you draw a Fibonacci from swing low to swing high. What happens is that the Fibonacci tool will print horizontal lines on those Fibonacci levels we mentioned earlier. So you'll be able to see from the chart that these Fibonacci levels are the Fibonacci levels you should be looking out for, you should be waiting for, right? To enter your continuation in the previous trend. To enter trades continuing with the previous trend that you're already watching, in this case, an uptrend, right? Now, for a downtrend, you are looking mostly to take your Fibonacci from a swing high to a swing low. So you draw your Fibonacci from a swing high to a swing low, and then you see that the Fibonacci will print horizontal lines for you across those Fibonacci levels. Across those Fibonacci levels, then you'll be able to know that, okay, now I have seen this impulse, this sell impulse. I've seen a sell impulse. I'm expecting market to correct to somewhere along that impulse level, I call that impulse line, for me to enter a continuation. Because I already know that I'm in a downtrend. I'm expecting price to continue to sell, but I know that it will not continue selling immediately. It will correct first. Then once it's corrected, it will give me an entry around that area of correction, and then I'll be able to get on a sell, which is the trend that is already playing out, right? So this is how you draw it for uptrend, downtrend. You can use these tools whether you are on TradingView on MT4 or MT5. So there's an example here. If Euro USD moves from 1.0 all the way to 1.5, that is an impulse buy. You can see that price appreciated. That's a 500 pip move right there, right? That's a 500 pip right there, right? Now, you are expecting it to correct and then give you a continued buy trade. What you do is you take your Fibonacci, you draw from this swing low, which is the 1.10 level, and then you draw it to the swing high, which is 1.15 level, right? So now the levels where you are expecting price to correct into will just display, will just be simply printed out for you. You just see them, they appear on the screen, right? So what are the key levels we are looking for in the market? Which are of these Fibonacci levels, which are the most important ones that we're eyeing, that we're looking at very keenly? There are three very important levels here. Three very important. Of course, we can see, we mentioned earlier, there were the 23 level, there's a 38 level, there's a 50 level, there's a 61 level, there's a 78.6 level. But of these three levels, of these five levels, basically, which are the most important levels? most important levels are these 3 levels. So the 50 level is a strong Fibonacci level number and is widely respected. So this is 50% is like the 50 is like a half of a move, right? Hold on, guys, we're demonstrating this. It's like the half of a move. So price moves from one level to another, and then once you plot a Fibonacci from the swing low here to the swing high, 50% will usually be the midpoint of that impulse. 50% will usually 50% retracement level will usually be the midpoint of that impulse. Usually, what price does is it corrects into the 50% level and then continues. So you see price moves from a swing low all the way to a swing high. Then it corrects to the midpoint of that impulse. Then it continues. Right? So this is the way it works for 50% level. So 50% level is 50% level is a level that some traders swear by for certain instruments. If you're trading an instrument like Euro USD, you know that 50% level is very, very strong. Euro USD, 50% level is very strong. If you're trading gold, 50% level will play out, I would say 50% of the time. 50% of the time, gold, right? If you're trading a pair like GBP USD, I would say 50% retracement will play out around 50% of the time as well, or 60% of the time as well on GBP USD. If you are trading USD JPY, for example, you see that 50% level will play out probably around 40% of the time. 40% of the time. So it's a pretty significant level to watch on the Fibonacci, right? Now, the next level, which is a stronger level, is what we call the 61.8 level. It's a key level. It's called the golden ratio. And it's either you see it as 61.8 or you see it as 0.618. So if you usually on TradingView, you see it as 0.618. When you are on MetaTrader, you see it as 61.8. It's exactly the same thing. Right? So this level is very key because it's called the golden ratio. This is the place where price will reverse most of the time. Now, it doesn't reverse here all the time, like I mentioned in several instruments. You will see price reverse here somewhere around 70% of the time. Price will reverse around the 61.8. For 50% level, you see mostly it's around the 50% level. 50% of the time, price reverses around the 50% level. But for 61.8, around 70% of the time, price or more, or a bit more, 75% of the time, price will reverse around the 61.8 level. So that's a key level you are watching. Then the next one, we have the 78.6%. That one, we call it the deep retracement. Then this is when price goes beyond the 61.8 and you're thinking, is market reversing totally? Has this market changed its direction totally? So market was in an uptrend, just buying. Then it begins to sell, and you say, okay, this is a retracement. I should expect the retracement to terminate around the 50 level or the 61.8 level. Then you see that price is so strong, maybe due to fundamental events, or something, or a strong correlation with an instrument that is being affected by fundamental events, right? Let's say an instrument that's related with gold or USD, the currency. So you see that price, instead of price to get to the 50 level or the 61.8 level and reverse, it breaks through those levels and comes to the 78.6 level. And when it gets there, you start to see price starts reacting there, and then it starts going direction that you had initially anticipated. So this is usually referred to as a deep retracement. The deep retracement. Of course, when price goes beyond that level, of course, you know that market has changed direction. There's no more retracement. That is complete reversal now, right? So yeah, we're going to look at that. We are chat. Now, when and why Fibonacci works? Fibonacci works mainly because of market psychology. Traders watch these levels. I said it before. I said the reason why a lot of technical analysis tools work is because traders expect them to work. When most technical analysis happens because traders are expecting it to happen. So where market reverses, it's usually areas where market is expected to reverse, except something happens in that period of time. But most of the time, you see market reverses around psychological levels, around Fibonacci levels. Why? Because the market is already waiting for that. If 1 million traders holding hundreds of billions of dollars think that price is going to sell at a certain level, then what we are going to do with the actions we will take will usually force price to do what we already expect. So if we expect to sell, what are we going to be doing? Placing sell orders. And when we are placing sell orders, what we are doing is that we are flooding the market with volume, with supply. We are doing a whole lot of supply. We are pushing supply into the market. And when you push supply into the market, and demand remains the same, it's just the law of economics. It's a simple law. Market starts to come down. That's why we say that the law of supply and demand is what drives the entire market, right? And mainly because traders watch these levels. Number two, algorithms are programmed to react to these levels. Now, when we say algorithms, you need to know that a lot of institutional traders, hedge funds, they trade the markets using algorithms. There is not one person sitting on the chart, analyzing the markets and holding billions of dollars. No. Some of the most profitable hedge funds in America, some of the largest funds across the world, they don't even have human beings trading. What they do is that they have human beings working on building algorithms that trade. Instead of hiring finance professionals most of the time, they hire math nerds. They hire a lot of people that are good professors of mathematics, PhD mathematics. That's what these finance firms hire. Why? What are they doing? They're trying to bring their heads together to build algorithms that will actually trade the markets rather than individuals and human beings trading markets. Why? Because when algorithms trade, they don't trade with emotions. They're mechanical systems. They place buy and sell orders, they close trades where they should close it, they use the right volume. There's nothing, they're not trying to achieve anything, they're just software, right? So very important, algorithms are developed using with these tools, with these Fibonacci levels coded into them. So you see that algorithms are trading and then they are respecting those tools, those Fibonacci levels as well, because they were built like that. And also another thing is the confluence. These Fibonacci levels confluence with other tools as trend lines, moving averages, support and resistance. A lot of times you see that price tends to confluence with them. Confluence means that correlates. It means that where a Fibonacci level is already, you see another confirmation there. In the market, we call confluence is confirmation. So but it's a situation where you have one or two or three things or indicators telling you the same thing. You're already expecting a buy for some reason, and then you see a Fibonacci level there telling you to buy. Then you see a trend line there passing through the same place telling you to buy. That's what we call confirmation. Then you see a moving average crossover happening there. That's extra layers of confirmations. So what that does is you are now a bit more convinced than you would normally have been that is probably going to be a very good buy trade or a sell trade, depending on which direction you're going. Right? So here's the thing. This is the entry strategy. Entry strategy, wait for price to pull back to the 50. Like we said, like I'll demonstrate it shortly. You take a swing high, you take a swing low and a swing high, right? So if it's in an uptrend, like we mentioned earlier, if it's in an uptrend, you take a swing low to a swing high, and then you wait for price to pull into the 50 or 61.8, and then you buy. That's for an uptrend. Then the next thing you want to do is you wait for confirmation before you buy. When price gets into that 50, 61.8 level, before you place your buy, you hit the trigger, you wait for a little bit of confirmation. You want to use a candle pattern or any other strategy like divergence to be able to know give you an extra layer of confluence, like we mentioned earlier, extra layer of confirmation. So you know that, all right, I'm already Fibonacci is already telling me that it's time to buy. Then a candlestick formation happens there again, either a hammer or a bullish engulfing, bearish engulfing. If unique candlestick pattern forms at that place, which is now giving you confidence that this market is likely to do what I already expected. Then stop loss level. This is how you enter. Once you have seen that, you pull your trigger for a buy or sell. Now, when it comes to stop loss, where do you place your stop loss? Let's say you make a buy trade. Where are you placing your stop loss? Placing your stop loss at a level below that 61 level, because that's where you expect price to reverse from. So your stop loss should be hidden behind of 61 level. So you should be looking at. Then for take profits, you can use take profit. You can take profit at the next swing high. So once price is activated, you can take profit at the next swing high. You can use the same high you use, just the same high you use for that particular Fibonacci retracement. Right? So we need to learn to combine Fibonacci with other indicators. Fibonacci plus support and resistance, very important. I just mentioned confluence or confirmation, very important. You want to be able to confirm what you're already expecting to happen. If you are confirming what you're already expecting to happen and you're getting confirmations for what you already expect to happen, that's very significant. Very significant, right? You are able to see that, okay, I'm already expecting price to buy, and I'm also seeing a demand zone here. Seeing a demand zone here, or a support. Support is also not a demand zone. I'm seeing a demand zone here, and I'm already expecting to buy. What that is telling me is I have confirmation for my buy. And you can use Fibonacci also with some other technical analysis tools, some indicators like the RSI, like the MACD. Those ones are good for markets that are not trending a lot. When they are not trending a lot, this may be good. Or if you're going to use indicators, make sure you use the slower moving indicators, the slower settings. Those the slower settings are better for trending markets. If you are looking to trend, you are looking to use indicators on a trending market as confirmation, you want to use the slower ones. Instead of doing an RSI setting of 4 or of 10 or of 20, you can do an RSI setting of 50 or 100. So that's a slower one. So that will not get you into a bad trade. That will filter out the bad trade so that it can give you proper confirmations for your Fibonacci. Right? The same thing. And then trend lines and channels. So when you have your Fibonacci plus trend lines coinciding with each other, you see this sometimes. It doesn't happen all the time, but in very rare occasions, you see that you draw Fibonacci, then a trend line passes through that same exact area. That is an extra layer of confirmation. You know, there are certain areas in the market that you can literally place your money and go away. You are so confident that the market will reverse around this area. This market will do, this price will do exactly what I expect it to do at these levels. You almost know it, even though you don't use the word no, still saying, okay, I believe this is going to happen. But you have it, your level, your confidence level is literally through the roof at that time. But how does that happen? Confirmations. You don't just look at the chart by itself and say and get that level of confidence. It is confluence. It is a confluence that arises from using several tools together. That's what leads to that level of confidence. So these are some common mistakes that traders might experience using Fibonacci. Using it in a non-trendy market. So if you're using Fibonacci in a non-trendy market, it could work, but sometimes you will see that it does not respect those levels, especially the 50 and 61.8. And even if it respects it very, very slightly and still changes direction quickly. So in that case, you should ignore using Fibonacci for very trending markets. Very trending markets. Now, of course, there are still some instruments that even though they are not trending, Fibonacci still works very well with them. But on a general note now, it's best to use Fibonacci for trending markets rather than ranging markets. So when you ignore structure, another one is ignoring structure and context. So you are looking at, you need to look at Fibonacci in conjunction with other things, the charts, not alone. Because, and the thing is this, guys, there are many times where we are looking as traders, we're looking for the easy way out. Easy way, just give me the one thing that I need to make money every single day without fail. But I shouldn't lose one trade. Fortunately, why that is so fancy, it's not even possible to have such a thing. Because just like you cannot predict the emotions of people, if you're on the road going to wherever you're going, you don't know what the other driver who's on the road is going to do. You don't know, you have no idea. There's no way to know what the actions another person is going to take, the sentiments another person is going to display. And because of that, that's the reason why you can't have one single tool that will tell you how to read the market 100% all the time. It doesn't work that way. So what we are saying now is that you have to use a couple of tools together in confirmation, in conjunction with other ones. So we're saying use Fibonacci in conjunction with structure, market structure, trending markets, and all of that. Support, resistance, demand zone, supply zone, all of that. Not adjusting after new high. So this is something I will be able to show us on the charts. Now, when Fibonacci levels, when you take a swing high, swing low for an uptrend, and then price doesn't get into the 50 to 61% level, and then goes off to break the previous swing high you took, then this previous swing high becomes invalid. You now have to extend your Fibonacci to the new high in order for you to get an accurate Fibonacci reading, right? You won't be able to get an accurate Fibonacci reading if you maintain the previous peak level that you used, because market has moved. Once market moves, you adjust your Fibonacci level. Once market moves, you adjust your Fibonacci level. So we're going to go into do some practice there. So this is something that you are going to do. Let's get into some practice first before we come back. Here. So here is a chart, for example. Let's look at this. This is Euro USD. I just bumped on it right here. Okay. So when you look at this is a daily chart. Sometimes I could do this when I expect certain moves to happen. Because usually there will be smaller moves inside here, and there have been a lot of smaller moves inside here. But the thing is that you have to understand as well that when you look at time frames matter, depending on how certain instruments play out, right? Now, if you want a heavy move, a significant move on certain instruments, you might need to look at them from a higher time frame. If you are just looking to scalp, then you may look at them from shorter time frame, is fine. Now you can see that the market has been seriously trending. This is Euro USD. The market has been trending very seriously. And this is primarily because the dollar index has been weakening for a while. And so because the dollar has been weakening for a while, Euro USD has been very strong because Euro has this relationship with the dollar, right? So what we want to do now is that we will notice that what is the most recent swing high and swing low here on this daily chart now. We are working with the recent swing high and swing low. This is a recent swing low, a recent swing high. So since we're having this as recent swing low and swing high, what we then do is that we take the Fibonacci, we draw from this swing low to the swing high, get our Fibonacci levels. Okay, now before I do this, let's see how the Fibonacci comes. Now this is my Fibonacci level. You notice that my Fibonacci level has 0. It has 0.5, that's the 50% level. It has 0.618, which is the 61.8 level. It has its 0.786, which is the 78.6 level. Then it has the 100 level, which is the 1 level, right? 1.0 level. Now, this Fibonacci 2 here has already been worked on. It's been worked on. I have edited it. I have made it look exactly the way I want it to look. But if you're opening the Fibonacci 2 for the first time, it will not look like this. So let's go to settings so I show you how it looks. So under visibility here, visibility of style. Under style, yeah. Under style here, you see that there are lots of levels that can show up on the Fibonacci retracement tool. But for me, I have only limited the lines that will show up, the levels that will show up to only 3. So the 1 level is constant, one is constant, 0 is constant. So I'm only working with 3 levels here. The 50% level is the middle of the move. If you check from 1 to 0 here, if 50% level is usually the 0.5%. So what we are saying is that this: when price makes an impulse like this is an impulse move on price. Price move from this level to this level here. Right? So what happens is that price will need to make a pullback to the 50 or 61% level before it continues. We can see that this is an impulse move here. Impulse buy move. We expect price to pull back and then continue, right? So what we do now, this is our most recent swing high and swing low. Most recent. And most recent is basically dependent on the time frame you're looking at. Now, I'm on a daily chart here, and my most recent is this level and this level. Swing low, swing high. Now, if I go on a lower time frame, on 1 hour, you see that I have a different swing high and swing low. But your understanding about how an instrument works will determine which level you use, which time frame you use for this. What I know is that if I'm trading Euro USD, for me to use a daily chart is very good. I can use a 15-minute chart. I can use a 1 hour chart too. All those are good. Right? All those are good. If I'm trading Euro USD, I know that. Probably it's because of my own method of trading. Right? So that I can do what I'm doing now. I can do it on a 1 hour, I can do it on 4 hour. But I choose to do it on the daily chart because I also like the outcome of the day, especially when you are expecting price to make significant moves. The daily is a very good place to go to, right? So now I can see that this is a swing low, this is a swing high, right? So what I want to do now is I'll take my Fibonacci tool and then I'll place it from the bottom to the top here. Okay, I was saying something earlier. So this is the Fibonacci tool here. Now look at this. I selected 0, 1, 0.618, 0.786, 0.5. So I checked all these ones because those are only the levels I want to show up on my chart. The other ones, if I check this now, 0.32, it will have to appear on the chart as well. See, it has appeared there. If I uncheck it, it goes away. If I decide to check the 0.236, it appears there as well. If I uncheck it, it goes away, right? So that's the way it works. I am the one that selected this. So you can definitely select these yourself and decide the levels. And these are the best levels you should take. But what I'm just saying is that when you want to do this for the first time, you won't see the way mine is appearing right now, but you can always customize it. You can always uncheck everything else and only leave the levels that you want to use. Okay. So here's the thing now. We take our Fibonacci level here. We draw from the swing high to the swing low. We draw from here to here. So what that means now is that this is the 50%. And you see, this right here is a 50% level. This is the 50% level. This is the 61% level. So what I'm saying is that I'm expecting price to pull back from this top to this middle to the 50 level here and then buy. Or if it doesn't change direction at the 50%, let it come to the 61% here and then buy. That is exactly what I'm expecting to happen. So the 50%, 61% level here gives me a good idea as to how price is going to play out. Where is this market is bullish, but I can see that price is facilitating a pullback. But where is this pullback or this retracement going to terminate so that I can get on the trade that correlates with the main trend? The major trend here is the uptrend. But I want to get in a place where the market can actually, where I know that I will have minimal drawdown, and I'm expecting actually a reversal. So this is what I'm doing here. Price pulls into this 50 level or the 61 level, and then I get on my buy trade. Why buy? Because I'm in an uptrend, and then this becomes my move, right? So yes, that's what is here. Now let's look at this chart that I'm on right now. Let's look at this chart that I'm on right now, right? So I take my Fibonacci from this swing low to the swing high. So I do that. I want to know where is price going to pull back to. You see this now? So you can see that this is my 50% level here, and this is my 61% level here. So what I'm very expecting now is for price to jump into these levels here, 50, 61. If it breaks through the 50%, it should come to the 61 and reverse around here. So I'm expecting this to happen now. Price come into this level and then buy and go up, or at least go up here. But what we said then was that your stop loss should be some level below the 61.8. That should be around this level. That should be around that level. You can also decide that you want to put it below here if it's not too wide, so that in case there is a deep retracement, we talked about 78.6, we said that's a deep retracement. In case there's a deep retracement, it doesn't take you out, right? And decide to do that, or you can just be safe and put it under the 61.8 here. It's fine. That becomes your stop loss. So you're entering, you're in a bullish market. You expect price to pull back into the 50 or 61% level. Let's say price gets to the 61.8 level here. You're meant to enter this trade somewhere around here. You're meant to enter this trade somewhere around here, right? Your stop loss should be below. This is a buy trade. Remember, we're in a bullish market. So your stop loss is expected to be below the 61.8, and then you're meant to ride this up. And then we talked about another thing. We said, where do you take profit? You want to take profit at probably the next swing high. This is the next swing high. This is the swing high that you use for this Fibonacci. So you can take your trade here, hold the trade up to this swing high level, and then exit your trade there. So this is just a simple illustration of how the Fibonacci works. And you can do this for all kinds of instruments. I personally use Fibonacci for almost all instruments. All right. We said it works for different instruments. Said it works for so many different instruments, right? Exactly. So you go now and practice this on other instruments. Like I said, you can do it on a 1-hour chart, you can do it on 4-hour, you can do it on daily, you can even do it on lower time frame as well, depending on what you trade. If you are a scalper, you can use it on lower time frame, 1 hour and below. If you are a day trader, you can use it on a daily chart or on a 4-hour or a 1-hour chart. Depends on here, right? So that's the way it works. Now, so you need to do this. Practice it on Euro USD, JP USD, Gold, BTC. Identify swing highs and swing lows. This is how you are going to do it now. Identify swing highs and swing lows. Mark and interpret retracement zones. So something else I didn't add here is, while you're trying to enter around here, what we mentioned earlier is that you are looking for areas of confirmation, right? You're looking for areas of confirmation. And those areas of confirmation can show up with maybe a price action thing happening around here. You might see a bullish engulfing here. If you see a bullish engulfing or a hammer candle here, that is an extra layer of confirmation telling you that price is actually about to reverse around that area. So price mark and interpret retracement zones, predict price reaction areas. Where is price going to react? This is what I'm doing right now. This is what I'm marking it, and I'm predicting that price is going to get to the 61.8 and then reverse. That's what you need to go and do on your chart. Take a chart and do this on your chart, right? So draw Fibonacci on 3 trending charts. Identify your 50 and 61.8 levels. Combine with other indicators for confirmation or for confirmation. Write it in your trading plan, which means that you know what works now. But add it to your trading plan as to what works for you. For example, I was mentioning different instruments earlier. I mentioned Euro USD, I mentioned GBP USD, I mentioned gold, I mentioned USD JPY. The reason I mention these things is because I've used Fibonacci for all these. I know how it works for each one of them differently. So that's what we are saying here. Write out your trading plan based on your findings. So based on my findings now, I can say that, oh, for Euro USD, I expect if I'm in a higher time frame like the daily chart and it's long term, like what is going on right now, expecting price to get to the 61.8. But on a regular day, when market is just moving on Euro USD, I would say that 50% retracement level is what I would expect probably 80% of the time on a 1 hour chart. I'll expect 50% retracement most of the time, 80% of the time. But when I go to daily chart and I'm looking for a trend that's continued for a while, I'm expecting 61.8. Then when I go to GBP USD, I'm expecting 50%, I would say 50% of the time. Then I'm expecting 61% also for the 50% of the time. Also, just across different instruments like that, that's what I personally see. So Fibonacci levels provide high probability reversal zones, very, very good probability reversal zones. Best used with trending markets and then also confirmation tools. You need to practice to develop this, right? So market is driven by human emotions. Fibonacci levels are the footprints. I've mentioned this, I said this from the beginning, that this market is driven by human emotions. So what you are seeing on the Fibonacci at the Fibonacci levels is just price. It's just like the footprint of price. So it's just a mark. Oh, this is where someone has been. This is where the market has been. That's what Fibonacci level is telling you. Fibonacci is built. It's one of those very effective tools that you can use with technical analysis, right? So guys, like we said here, go back and use these things and then practice over and over and over, and then you'll be able to get it. Use it on different time zones and be able to get you'll be able to get it right. Do we have any questions? Who has a question? We have just 1 minute to go. Any questions? I know that when we come in like this and you have so much information, you may not have questions yet. But what the most important thing is to get back and start to use what you have learned. Get back using what you've learned, and then you'll be able to advance with it. Right? Thank you, guys. For now, I'll see you guys on the next one.